Good morning. Today we're covering a major shift in global finance. Citigroup, one of the world's largest banks, is selling its entire Russian banking business. This move is not just a simple transaction, it's a significant strategic decision that will have ripple effects across the financial world. For years, Citigroup operated AO Citibank in Russia, serving both individuals and corporations. The bank provided a range of services from personal banking to corporate finance, becoming a staple in the Russian financial landscape. But now, the bank is making a complete exit, marking the end of an era. This decision is not just about closing a few branches, it's about withdrawing from an entire market. This isn't just closing a branch, it's like a major retailer leaving an entire country. The impact on the local economy and the banking sector will be profound. The decision comes with a hefty price, a $1.2 billion loss. This financial hit is substantial, but Citigroup believes it's a necessary step for their long-term strategy. Why now? The answer involves geopolitics, financial regulations, and currency shifts. The current global climate has made it increasingly difficult for foreign banks to operate in Russia. We'll break down why Citigroup is leaving, who's buying, and what this loss means. Understanding these factors will give us a clearer picture of the global financial landscape. This story shows how global events can force even the biggest companies to rethink their strategies. It's a reminder that in the world of finance, nothing is ever set in stone. The journey to this decision was long and complex, shaped by years of global change. Citigroup has been navigating a challenging environment, and this sale is the culmination of those efforts. The sale, confirmed just days ago, is the final step in Citigroup's careful withdrawal from Russia. This marks a significant moment in the bank's history. The financial world is watching closely as Citigroup closes this chapter and looks to the future. The implications of this move will be felt for years to come, both for Citigroup and the global banking industry. To truly understand Citigroup's exit from Russia, we need to rewind to the pivotal year of 2022, when the world was watching events unfold with uncertainty. After the conflict in Ukraine began, the business climate in Russia changed overnight. The city's once bustling financial districts grew quiet, and a sense of unpredictability settled over the market. Sanctions and political tensions made it risky for foreign firms. International banks faced mounting pressure, with new restrictions and the threat of further escalation looming over every decision. Citigroup, facing a maze of complex regulations and growing uncertainty, announced it would wind down its Russian consumer and commercial banking operations, a move that would impact thousands of clients and employees. Instead of a sudden exit, the bank chose a careful, gradual approach, closing branches, halting new accounts, and steadily reducing its exposure to the Russian market. Each step was measured, aiming to minimize disruption for customers and staff. But winding down a bank is a complex process. Loans, deposits, and employee contracts all had to be managed with precision. Every detail mattered, from regulatory compliance to customer communication. Over time, it became clear that a slow retreat wasn't enough. The challenges of operating in a volatile environment only grew, and uncertainty continued to cloud the future. The best solution Citigroup realized was to find a buyer for the entire operation, a move that would provide clarity and closure for all involved. After years of searching, navigating regulatory hurdles, and negotiating with potential buyers, Citigroup finally secured a buyer and the necessary approvals to move forward. Selling, rather than slowly closing, marks the final step in a strategy that began back in 2022. It's a decisive move, signaling the end of Citigroup's presence in Russia. This sale is the culmination of years spent navigating a volatile and unpredictable environment, balancing risk with responsibility at every turn. It allows Citigroup to draw a clear line and officially exit a market that no longer fits its global strategy, freeing up resources to focus on more stable and promising regions. A significant chapter in Citigroup's history comes to a close, marking both an end and a new beginning for the company's global ambitions. So, who's taking over? The buyer is Renaissance Capital, a major investment bank in Russia and emerging markets. Renaissance Capital, founded in the 1990s, is known for handling big financial deals and has deep roots in the Russian market. By acquiring AO Citibank, it gains a ready-made banking infrastructure and a portfolio of corporate clients. For Citigroup, selling to a respected local player ensures a stable transition for clients and employees. Renaissance Capital's takeover provides continuity and strengthens its position as foreign competitors exit. The sale needed more than a handshake. It required approval from President Vladimir Putin. Since 2022, Russian law mandates presidential approval for major asset sales by companies from unfriendly countries like the US. This rule gives the Russian government control over strategic assets and ensures deals align with national interests. Without Putin's sign-off, the sale couldn't happen. His approval in November 2025 cleared the biggest political hurdle. It's a reminder that in today's world, business and geopolitics are deeply intertwined. Let's talk about that $1.2 billion loss. It sounds alarming, but it's not a simple cash loss. Most of it comes from what's called a currency translation adjustment. Over the years, Citigroup's Russian assets were valued in rubles, but reported in US dollars. As the ruble weakened, the dollar value of those assets dropped. When Citigroup sold the business, all those accumulated, on-paper losses became real on the books. The loss isn't from selling at a fire sale price, but from years of currency shifts. It's a non-cash charge, an accounting reality, not a sign of mismanagement. The sale simply triggered the need to recognize these changes officially. It's a story of exchange rates, not a collapse in business value. Let's break down how currency translation losses can impact your finances, especially when dealing with international transactions. Imagine you're traveling abroad and decide to buy a collectible comic book for 800 euros. At the time, the euro and the US dollar are equal in value, so you pay the equivalent of $800. Fast forward a few years, you decide to sell the comic book and you get the same 800 euros for it. But now, the exchange rate has changed. 1 euro is only worth 50 cents in US dollars. When you convert your 800 euros back to dollars, you only get $400. Even though the comic book's price in euros stayed the same, you've lost $400 just because of the currency shift. Now, imagine this scenario on a much larger scale. That's exactly what happened to Citigroup, one of the world's biggest banks. Citigroup had significant assets in Russia, valued in rubles. When the ruble was strong, those assets were worth billions in US dollars. But over time, the ruble weakened dramatically against the dollar due to economic and political changes. This meant that, even if the assets' value in rubles didn't change, their dollar value shrank. When Citigroup eventually sold its Russian business, the difference between the original dollar value and the final amount received became a real, tangible loss. This $1.2 billion loss was simply the result of converting rubles back to dollars after years of currency decline, not because the business itself failed. It's important to understand that this isn't a penalty or a sign of mismanagement. It's just the unavoidable math of global finance and currency fluctuations. Citigroup's team didn't make a bad business decision. They were simply caught in the unpredictable swings of the currency market, something every international company faces. The loss is the price of operating in a volatile, interconnected global market where exchange rates can shift suddenly and dramatically. Ultimately, it's a powerful lesson in the risks and realities of international banking, and a reminder that currency changes can have a huge impact on even the biggest financial institutions. Citigroup says the deal is capital neutral. What does that mean? Capital is a bank's safety cushion, money set aside to absorb losses. Normally, a big loss would shrink this cushion, but in this case, the currency losses had already been quietly reducing Citigroup's capital over the years. When the sale happened, the $1.2 billion loss was offset by reversing those earlier adjustments. The net effect? Citigroup's core financial strength remains unchanged. Investors can breathe easy. The loss looks big, but the bank's foundation is solid. Capital neutral means the exit doesn't weaken Citigroup's ability to weather future storms. Selling AO Citibank isn't the end. Citigroup still has some business in Russia. These remaining operations, mainly services for multinational clients, are now classified as held for sale. This signals a firm plan to sell them soon, likely within a year. By separating these assets, Citigroup clarifies its financial reports and strategy. The bank is methodically untangling itself from Russia, focusing on core markets elsewhere. The held for sale label is the final step toward a complete exit. Citigroup's Russian story is nearly over. As 2025 ends, Citigroup's Russian exit is more than a business deal. It's a turning point. The move highlights how global risks now outweigh the rewards in some markets. The $1.2 billion loss is an accounting story, not a sign of collapse. The capital-neutral outcome reassures investors about the bank's health. For other companies, this is a case study in the challenges of leaving a politically sensitive market. Citigroup's focus now shifts to its most stable, profitable businesses. By closing this chapter, the bank is free to pursue a new strategic direction. It's a decisive step into 2026 for one of the world's financial giants.